It's 20 years since the Asian financial crisis, and as the Vice President said, there have been many important strides. And it's, I think, a good time to take stock of where we are and where the remaining challenges are. And I'd like to tackle three topics today. The first one is on the current state of the global dollar funding network. And then I'll move on to two topics that are especially well dealt with by the ADB, which have to do with the local currency bond market. And I'll touch on the challenges posed by local currency bond markets for monetary policy and then for financial stability. So let me move on to the first topic, which is on global dollar funding. Now here is a very stark way. It's a bit of a caricature. It's a caricature of how conventional financial economics, international finance views the financial system globally. And the picture is of each country as an island separated by the ocean. And the exchange rate is the price that adjusts the trade balance. And whether the currency is strong or weak determines its trade balance and therefore determines economic activity. This is a very much a caricature, but it's a typical way of viewing the world. Let me put forward another view, which is looking at the financial side of exchange rates. So what I will do is explain a bit on the financial channel of exchange rates, which in many ways operate in a slightly counterintuitive way. So here the picture, instead of islands, is of a very dense connected network of nodes. And the nodes are balance sheets, and the connections are balance sheet claims and liabilities. And in this picture, exchange rates do more than simply determine the trade balance. It also affects various financial prices and risk-taking, which have financial stability implications, but also through risk-taking have a real economy set of implications as well. And in this world, a depreciation far from being contractionary turns out to be expansionary. Far from being expansionary turns out to be contractionary. So when your currency depreciates, especially against the US dollar, it turns out that this is actually going to be depressing economic activity rather than stimulating it. Now, 20 years after the Asian crisis, the financial system has changed in some respects, but there has been one constant, which has been the very important role of the US dollar as the currency that underpins the global banking system. And these two charts are drawn from the BIS banking statistics. And they show the cross-border assets and liabilities denominated in US dollars reported by the BIS reporting banks. So these are mainly advanced economy banks, but also a very large number of emerging market banking systems as well. The upward sloping bars are the assets are the cross-border assets, and the liability, and the downward sloping bars are the cross-border liabilities. The left-hand panel gives you the cross-border claims and liabilities of the BIS reporting banks by the location of the reporting bank. And if you look at your handout, the one in the middle, the one that's pink in this chart is for the US banking system. And then the blue is the Euro area, the yellow is the UK, and so on. And these are very large numbers. If you look at the vertical axis, we're talking about somewhere in the region of $14 trillion assets and liabilities. If we look on the right-hand panel, this is the same number, but it's the cross-border assets and liabilities of the reporting banks, but arranged according to nationality. In other words, it's the location of the headquarters. So it's a different way of looking at the same total. And so if a German bank's branch is operating in London, on the left-hand side, that's classified as UK. On the right-hand side, that's classified as Euro area. And you see the very important role of European banks, but also of Japanese banks, as you see there. Now, why is global dollar funding important? Well, it turns out that the dollar funding map is a very important determinant of risk-taking and global financial conditions more generally. And one topic that Dean Yoshino mentioned earlier is currency hedging by advanced economy commercial banks that are taking on the hedging pressures of both financial and non-financial entities. And in Japan, a very important activity of the commercial banks is to allow the hedging by long-term institutional investors, such as life insurance companies and pension funds, to hold a much more diversified portfolio of global assets. And if a life insurance company holds a US dollar denominated asset and wants to hedge it so that the currency mismatch is taken account of, then the typical way would be to sell the dollar exposure to a bank who then has to use its own balance sheet to lay off the currency risk. So one consequence of the role of hedging pressure is that the interest rate spread between the dollar interest rate implicit in currency swaps and the standard interbank interest rate has diverged much more to higher levels in the last couple of years. What this chart shows you is the relationship between the level of the dollar, which is the red line, and the cross-currency basis, which is the difference between the interbank interest rate in dollars and the implied interest rate in dollars that's inherent in the currency swap contract. And when the blue line comes down, it means that the dollar interest rate implicit in the currency swap is becoming higher relative to the interbank dollar interest rate. During the crisis, which is the first dip of the blue line, we see that the cross-currency basis widens considerably. This is when the banking system was under stress and was therefore unable to intermediate some of the hedging pressures. Another instance was during the European crisis in 2011, 2012. But you see that since 2014, the cross-currency basis has widened. And if you look at the relationship between the blue line and the red line, you see this mirror image of the strength of the dollar and the cross-currency basis. What this suggests is that the price of balance sheet capacity is very much a function of the strength of the dollar, and it's a clue as to some of the things that you'll see shortly. That when the dollar is strong, this is when the banking sector balance sheets are under greater pressure to accommodate greater hedging needs. How does this play out in the local currency bond markets and for the real economy? Now, there were two important lessons from the Asian crisis. The first was that financial systems should avoid currency mismatch. And the second lesson was that it should avoid maturity mismatch. And in this respect, the local currency bond market is very well suited to address both these issues because the bond is issued in local currency, therefore the currency mismatch is avoided. And it's often, and it's almost invariably issued at fairly long maturities, and therefore the maturity mismatch is also avoided. And here, the ADB has played a very important role in the development of the local currency bond market. The Asian Bond Market Initiative, which was set in train by ASEAN Plus 3 in 2003, was the big initiative that kicked off the local currency bond market. The Asian Bond Fund 1, the ABF1, which was launched in 2003, was a way to, well, this is dollar denominated, but it was a way to kickstart interest in the local currency, the bonds issued by the central banks in the region. In fact, the BIS manages ABF1. And ABF2, which is the successor to ABF1, and it was launched at twice the size, at $2 billion in 2005. This was the local currency bond fund. And since then, the local currency bond market has not looked back. So there have been very important initiatives such as the Asian Bond Market Forum in 2010 and the Credit Guarantee and Investment Facility, which was launched in 2010 also. And the ADB website is a very good resource for all these types of initiatives. Now, has it solved all the problems? Well, let me mention a couple of issues that we can still see as remaining challenges. The first one is the way that exchange rates affect the economy. If we believe in the island's view of the world, where the exchange rate is purely driving the trade balance, then an appreciation is contractionary and a depreciation must be expansionary. But the risk-taking channel, so-called, operates in a very different way, where if there is a large stock of dollar-denominated liabilities that are financing assets that depend on the value of the dollar, then as the dollar depreciates, the liabilities shrink relative to the assets, and therefore the balance sheets of the borrowers become stronger or appear to become stronger. And from the point of view of the creditors, this increases this perceived creditworthiness of the borrowers and will result in a decreased measured tail risk of any kind of credit risk model, and will tend to result in an increase in the credit supply. Now, even in the case of local currency bonds, provided that there is a stock of assets that may be sensitive to the dollar in this way, we can imagine that the risk-taking channel will affect the broad range of financial assets. So here is some recent evidence that we will announce shortly. So these are some charts from a forthcoming working paper, which looks at 24 emerging economies. And through a panel VAR, we're looking at the impact of an appreciation of the dollar, both on cross-border bank lending, which is the left-hand panel, and on capital expenditure on the right-hand panel. And what we see is that when there is a dollar appreciation shock, we see a downward impetus to cross-border lending in dollars. And the middle panel shows that whenever we have a contraction in cross-border lending in dollars, there is a simultaneous contraction in capital expenditure in that country. So that if we put the two together, we have the right-hand panel, which shows that when the dollar appreciates, when there's a dollar appreciation shock, this has an impact on capital expenditure. So there is a real economy impact. And here I've just magnified that right-hand panel, where we see this very strong impact. Now, one clue as to what is behind this type of result can be gleaned from how the local currency bond yields behave as a function of the dollar. And so let me show you some results from, closer? From a paper with my BIS colleagues Boris Hoffman and Ilyok Shim. Let me show you some scatter charts first. So this is from mutual fund data. We looked at individual mutual fund data. We looked at both quantities and prices, and computed for each month the returns in dollar terms, which is the red line, and the return in local currency terms, which is the blue set of dots and the blue line. And the horizontal axis gives you the change in the yield, of the local currency bonds. So if we look at the left-hand side of this chart, we are looking at those states of the world where the yield has fallen. So these are states of the world when financial conditions are quite benign. These are expansionary financial times. And in those states of the world, the red lines tend to be above the blue line. In other words, the US dollar return tends to be higher than the local currency return, which is to say the dollar is tending to depreciate relative to the local currency. So during financially very ample times, you're better off holding your dollar returns from holding these local currency bonds are higher. On the contrary, if you look at the right-hand side, these are the states of the world when the yields have risen. So these are states of the world when financial conditions are tighter. And these are precisely those states of the world where the dollar returns are lower than the local currency returns. In other words, the dollar has appreciated relative to the local currency. So in these states of the world, if you hold local currency bonds issued by emerging market sovereigns, and these are sovereign bonds, your dollar returns are much lower because the dollar has appreciated relative to the local currency. We see a very similar type of evidence. We see very similar evidence if we look at the CDS spreads as well, and this chart shows you a grouping of snapshots of the relationship between the CDS spreads, the sovereign CDS spreads for a number of emerging markets, and how much the currency of that country has depreciated relative to the benchmark point, which we take to be the end of 2012. So we're just looking at the sequence of events from 2012 all the way up to the end of 2015. And the size of the bubbles indicate the dollar-denominated debts of a number of emerging markets. But the size of the bubble is not so important as to how the bubbles move. So as we turn the clock forward, as we go to the right in the top row, what we see is that as the dollar appreciates, so we're moving to the left, we see the CDS spreads tending to go up. And as we move to the period beginning in the middle of 2014, when the dollar starts to strengthen quite sharply, we see the bubbles moving up to the left and to the top. It's moving to the northwest, which means that as the dollar appreciates, we see the CDS spreads of the sovereigns also going up. And notice that this relationship between the CDS spreads and the dollar holds both in the cross-section and in the time series. That's to say, over time, when the dollar strengthens, we see the CDS spreads going up. But also at any moment in time, we see a downward sloping line where the currency which has depreciated most against the dollar tends to have the highest CDS spreads. So again, to the extent that CDS spreads reflect financial conditions, we see this inverse relationship between the strength of the dollar and local financial conditions. Now, the key point to note here is that these are the bilateral exchange rates against the US dollar. If we run a panel regression, and here this is just a straight panel regression where the dependent variable is the local currency spread of an emerging market sovereign bond. And the definition is just, it's the local currency yield divided by the equivalent US Treasury yield. And we regress it on a number of macro variables, which is all the variables at the bottom. But then we also include a number of exchange rate variables. And what we see is that the bilateral exchange rate, the appreciation of the domestic currency vis-a-vis the dollar, which is the delta BER. BER stands for the bilateral exchange rate against the dollar. That turns out to be a very important determinant of the local currency spreads. So when the domestic currency appreciates against the dollar, you see the spreads coming down. Now, interestingly, if you look at the second column, where we do the same thing, not for the bilateral exchange rate, but for the trade-weighted exchange rate, the nominal effective exchange rate, we see a much weaker result. And in the third column, when we include the orthogonalized trade-weighted exchange rate, which is to say that change in the trade-weighted exchange rate which is unrelated to the US dollar, we see that in the third column there is no effect whatsoever. So all this effect is coming through the US dollar exchange rate, and it points very much to a financial channel where it's the prevalence of US dollar denominated liabilities globally, which is seeping into the risk-taking and therefore the financial conditions more generally. Column 4 is a very interesting column to focus on, because there we include both the bilateral exchange rate as well as the trade-weighted exchange rate. And what you find is that they come out with opposite signs. So the bilateral exchange rate is very strong, and we see the impact of exchange rates affecting financial conditions. The trade-weighted exchange rate, if anything, has the opposite effect. So there, it seems to be going along very much with the conventional trade channel, or the Mundell-Fleming channel, if you like, where it's the depreciation which is the better news for the economy, and therefore tends to have more expansionary effects. Now, to what extent could this be just a result of monetary policy and forward rates coming in? Because one could argue, well, when the dollar is going up, this is going to affect monetary policy, and therefore, through monetary policy and signaling and forward guidance, this could have an effect on long-term sovereign bonds. And so the table on page 19 is designed to control for that. We're here looking at the Duschreger spreads, which are the spreads which are adjusted for the forward rate. So imagine that you are a dollar-based investor wanting to invest in a local currency sovereign bond in Asia. What you will do is you will take your dollars and swap those dollars into the domestic currency, and then invest in the sovereign bonds of that country. And then at the end of the currency swap, at the end of maturity, let's say, you then convert those back into dollars. So what the Duschreger spread does is to control for the forward rate that's implicit in the swap contract. And so here we are taking the implied spread in the swapped currency hedged investment in the local currency bond minus the equivalent maturity US Treasury bond, so that we're much more likely to be able to capture that component which is purely due to the risk premium rather than due to the forward rate that's implicit in the monetary policy reaction. And again, we see exactly the same result, that it's the bilateral exchange rate vis-a-vis the dollar which seems to be influencing this risk premium. So the risk premium that's inherent in the local currency bond dances to the tune of the US dollar. And if you look at the second column, it has no relationship whatsoever with the trade-weighted exchange rate. In fact, we have a much stronger result for the Du-Schreger spread by filtering out the forward rates. And when we put in both, it's only the bilateral exchange rate that becomes significant. Now, we can also do some time series analysis using a panel VAR. And let me show you some impulse responses from that. So these panels, these impulse response charts show you the impact of an appreciation of the local currency against the US dollar. And we control for all the standard macro variables, and we put the exchange rate last in order to make sure that we allow all the endogenous variables to have play. And the consistent message is that when the local currency appreciates against the US dollar, we see a compression of both the local currency spread as well as the Du-Schreger spread. And so it's the exchange rate which has a very important influence on domestic financial conditions. Now, this poses some very important challenges for monetary policy for an open economy, especially for an open economy, for all those open economies represented around this table, where the US dollar plays a very important financial role, because whereas the standard textbooks say we can see through the exchange rate will only have an impact through the inflation and the pass-through, exchange rate pass-through. In fact, a very important channel is the financial channel. It's the risk premium itself which is going to be affected by the exchange rate. And how should monetary policy respond? Well, it's not at all obvious how monetary policy should be modified as a result of the exchange rate channel. For example, if you have the local currency depreciating very sharply against the dollar, as we saw in the last couple of years, what should be the exchange rate response? Well, if it's a purely exchange rate pass-through effect to inflation, we should be raising rates in order to counter the inflation. But what we also know is that when the domestic currency depreciates very sharply against the dollar, this also tightens financial conditions also very sharply as well. And what should be the domestic response to that? Well, again, the answer is not clear. You may want to raise rates in order to defend your currency and therefore mitigate some of these effects. But equally, you may want to keep interest rates low in order to not to allow the tightening to have a big financial impact on your domestic economy. So there are no easy answers, but we have another set of issues which are put on the table as a result of the risk-taking channel. These are just charts for the quantities, and we also see the capital flows behaving in the standard way, where when the domestic currency appreciates, we have capital inflows. Now, the other challenge that I posed at the beginning is on financial stability and the likely response of bond market investors to financial distress or financial turbulence. As you know, the bond market has become very important in many emerging markets, but especially in those countries represented here, where the local currency sovereign bond market has become a very important asset class. And the blue portion there is the amount that we can capture through the collective investment vehicle, through mutual funds, and that's grown tremendously over the last few years. Now, one argument you hear is that long-term bonds in local currency should not cause great financial stability risks because it's long-term, therefore the runs will not be that damaging. And because it's local currency, the currency mismatch should be much less. And both arguments are, of course, very strong ones. They are the lessons that we learned from the Asian financial crisis. But let me focus on one potential channel which could act as an amplifier. And this is the actions of asset managers who are reacting to local financial conditions. Now, we tend to think of mutual funds as being passive investment vehicles which are purely managing its portfolio in response to their own investors. So when the investors put in more money, then they purchase more bonds. When the investors take out money, then they sell the bonds. Now, although that's largely true, I think an important element is also the discretionary element of portfolio management, and in particular the so-called discretionary sales and purchases of the fund managers themselves. In other words, do the sales and purchases reflect just the inflows and outflows, or do they reflect more the active decisions? And if so, which way does it go? Does the discretionary management of the managers act as a stabilizer, or does it act as an amplifier? So when would it act as a stabilizer? It would act as a stabilizer when, in the face of redemption pressures, the asset manager would reduce its cash holding and meet the redemptions without selling the bonds. That would be when it's acting as a stabilizer. On the contrary, if it's acting as an amplifier, this is when the manager is selling more than is necessary to meet the redemption pressures. Empirically, it turns out that the discretionary management is amplifying. In other words, the asset managers tend to behave in a way that where they sell more than is necessary when there are redemptions and buy more than necessary when there are inflows. So the cash balance is moving in a way where the cash balance increases during episodes of redemptions, and cash balance is decreasing during episodes when there are cash inflows. Because I'm running out of time, let me just give you a couple of quick charts. What we did was we looked at emerging market sovereign bond funds and tracked to what extent, just also by tracking the cash balance, we can define how much of it is sales or purchases that are driven by investors and how much of it is discretionary. And then we tracked the extent to which the discretionary sales and purchases co-move with the inflows and outflows. And let me just show you one table, and we can conclude. So this is a table that shows, on the left-hand side, the discretionary purchases and sales. And we are regressing it on the flow-driven purchases and sales. And we see that the sign is positive, which is to say, when you are buying more because of investor inflows, this is when you're also buying more on a discretionary basis. Conversely, when you're selling more because the investors are redeeming their shares, you're actually also selling more by reducing your discretionary holdings as well. In other words, you're increasing your cash at exactly the moment that the investors are pulling out. And the effect is roughly of the order of 13 cents to the dollar. So for every dollar's worth of investor-driven sales, there is a sale of around 13 cents, which is due to discretionary, of a discretionary nature. And there is evidence of a kink. There is evidence of an asymmetry where this effect is kicking in particularly hard when there is a sale. So what this means is that we're not out of the woods yet in terms of financial stability, especially when we combine it with the effect of the dollar, because domestic financial conditions depend very much on the sovereign yield curve as the benchmark. And the sovereign yield curve dances to the tune both of the exchange rate, but also of investor behavior as well. And we are now very familiar with the pro-cyclical nature of leverage over the financial cycle. But what the results also suggest is that we should also be aware of the pro-cyclical nature of the asset composition. So let me conclude. Global dollar funding is still very important, and this is important not only for emerging markets, but also for advanced economies. And as Dean Yoshino said earlier, global dollar funding is a very important issue for Japan. There are monetary policy implications because the yield curve is sensitive to the exchange rate. What the answer is also unclear. So I'm adding to the set of questions on the table. I have very few easy answers, but I think we have some clues as to what the right answers are, depending on the circumstances. And finally, there are also financial stability implications that have to do with asset manager behavior as well. So let me conclude there.